Welcome to The Explainer. You know, if you own property, it can be a fantastic asset. But let's be honest, when tax season rolls around, it can also be a total headache. So today, we are going to cut right through all that confusion and untangle the income tax on house property once and for all. Seriously, whether you're renting your place out or it's the home you live in, you absolutely need to get this calculation right. It is the key to avoiding major hassles with the tax department and, maybe even saving some serious money. So here's how we're going to tackle this. First, we'll figure out what house property income even means. Then, we'll walk through calculating something called the annual value. After that, we get to the good stuff, the deductions that lower your tax bill. We'll also look at the huge differences between a home you live in and one you rent out. And finally, we'll put the whole puzzle together.
All right, first things first. Before we can crunch any numbers, we have to get on the same page about what the tax law is actually talking about when it says income from house property.
Okay, this right here is the single most important idea to grasp. The tax isn't based on the rent you actually collected. It's based on the property's potential to earn money, what the law calls its annual value. Just think about that for a sec. That means you could technically owe tax on a property even if it was empty the entire year. So the big question is, how do they come up with this annual value? Well, it's not just some random number. It's the result of a very specific calculation, and it is the foundation for everything else we're going to talk about. To get to our starting point, the gross annual value, or GAV, we follow a pretty clear four-step process. First, we find two numbers, the fair rent, which is what a similar place in the area goes for, and the municipal value. You take the higher of those two, and that becomes your expected rent. And then comes the final showdown.
And this last step is the golden rule. Your GAV is the higher of what the property could have earned versus what it actually earned. And the reason for this is actually pretty smart. It stops people from, say, renting a fancy apartment to a cousin for $100 a month just to dodge taxes.
Okay, once you have your GAV, the next step is super simple. You just subtract any municipal taxes you paid during the year, like property tax. What you're left with is your net annual value, or NAV. And this is the number we get to start taking deductions from. All right, we've got our main taxable number, the NAV. Now for the part you've been waiting for, deductions. How can we legally and correctly shrink this number down?
Well, the law provides two main avenues for this. Let's start with the first one, which is also the easiest one.
30%. That's the magic number. This is the first and most straightforward deduction you can take. This is what's called a flat standard deduction. You just get to chop off 30% from your net annual value, period. It's meant to cover things like repairs and general upkeep, and the best part? You don't need a single receipt. It doesn't matter if you spent more or nothing at all. It's automatic. Now, the second big deduction is all about home loan interest. And for a property that you actually live in yourself, this number, 2 lakh rupees, is the absolute maximum you can claim as a deduction. And what kind of loans count? Well, you can deduct the interest you paid on a loan you took for pretty much anything related to the property. Buying it, building it, fixing it up, you name it. Just got to remember, for the home you live in, the total interest deduction is capped at that 2 lakh rupee limit.
Now, this is absolutely crucial to understand. These rules are not one size fits all. The tax treatment changes completely based on one very simple question. Do you live there or do you rent it out?
Let's put them side by side and see just how different they are. For your own home, the annual value is just nil, zero, which means that 30% deduction doesn't apply, and your interest deduction is capped. But now look at a rental property. You have to calculate the NAV. You get that standard 30% deduction, and here's the kicker. There is no upper limit on deducting your home loan interest. That is a massive difference for landlords.
So that brings up a really interesting question. With huge deductions like that unlimited interest on a rental, what happens if your deductions are actually bigger than the income the property brings in? Can you have a negative income? Well, the answer is yes, you absolutely can.
This is called a loss from house property. It's what happens when your deductions are more than your net annual value. And while loss might sound like a bad word, trust me, in the world of taxes, it can actually be your best friend. It's a powerful tool for lowering your overall tax bill.
So, what can you do with this loss? Well, in the same year you have it, you can use it to offset other income, like your salary, which directly lowers your taxes for that year. If you still have some loss left over, you can carry it forward for up to 8 years. The only catch is, in those future years, you can only use that old loss against new income from another house property.
Okay, we've gone through all the pieces of the puzzle.
from finding the value to dealing with deductions and even losses. So now, let's put it all together and see the entire calculation from start to finish.
And here it is, the whole shebang. You start with your gross annual value. You subtract municipal taxes to get your net annual value. From there, you take away the 30% standard deduction. And then you subtract your home loan interest. The number you end up with is your final taxable income or your deductible loss from your house property. It's simple, it's logical, and it's incredibly powerful.
What this all shows us is that owning property isn't just about collecting rent or hoping its value goes up. It's an active financial game. And now that you know the rules, you can play that game strategically. You can turn what might have been a tax headache into a really well-managed asset. So I'll leave you with this question. Looking at this formula, how does your property stack up?